Welcome to today's analysis of Vietnam's deepening economic predicaments as the Trump administration prepares to sharpen its trade policies once again. We'll dive into the layered issues threatening Vietnam's economy, unravel the implications of a weakening Vietnamese dong, and dissect the financial and global trade factors crashing the shores of this emerging market. Stripped of political jargon and government PR, let's see what's really at stake here. Before we begin, I have to ask, why do policymakers always seem to repeat the same mistakes, a dance we've seen so many times before? Of course, government spokespeople will tell you that these are simply the growing pains of an economy increasingly integrated into global markets. But let's be clear, there are real policy missteps that have led to this predicament. Vietnam's trade surplus with the US has expanded at an alarming rate, upwards of $100 billion in 2024, which puts the country in the crosshairs of Donald Trump's protectionist agenda. Didn't the government see this coming? Or better yet, did they think deepening trade ties with a volatile US administration would go unnoticed? First, let's unpack the economic implications of the Vietnamese dong's sudden weakness, and don't kid yourself, it's not happening in a vacuum. The dong has lost more than 3% since September 2024 and continues its slide closer to an exchange rate of 26,000 per US dollar. If current trends persist, we could witness the dong fall further to all-time lows, compounded by sustained inflationary pressures. There are two core drivers of Vietnam's currency troubles: external trade pressures and faltering global demand, both exacerbated by American protectionism. Over the last decade, while Vietnam successfully positioned itself as a critical player in global supply chains, relying heavily on exports, particularly electronics such as smartphones and semiconductors, has made its economy more vulnerable to external shocks. In addition, since Vietnam's trading relationship with China is tightly interwoven, any action that affects Chinese trades, such as tariffs targeting Chinese imports, clearly spills over into Vietnam. Now, let's face it, while Vietnam's meteoric rise to becoming a dominant Asian export power is laudable, failing to anticipate how this might provoke disdain among certain trade partners, notably the US, was a glaring blind spot. The trade surplus raised big, flashing red flags, especially for a Trump administration that has made targeting trade imbalances a cornerstone of its policy. Trump's "America First" doctrine always came with the implicit promise of pursuing tariff wars. China learned that in 2018, Europe saw hints of it, and now Vietnam may be next. You're probably asking, but hasn't the Vietnamese dong been weakening year after year? Yes, weakening, within reason, is a strategy. Normally, a more competitive dong translates to cheaper exports. On the surface, more sales, more deals, right? Well, not so fast. A too-weak currency could backfire by drawing greater scrutiny from trade partners, and this dynamic is especially delicate in an environment where the US dollar is rising across the board, squeezing emerging market currencies. In economic terms, tariffs on Vietnamese goods could be tantamount to an earthquake. So why is Vietnam in such an uncomfortable position now? Trump's trade strategy is simple but brutal: tariffs punish those reaping large trade surpluses with the US. Having already wielded this weapon successfully against China, it's no surprise Vietnam would be targeted next. But the Vietnamese government does not seem prepared for what might come next. Remarkably, Trump has let governments continue to believe that they can simply negotiate and soften the terms of any punitive tariffs by making ad hoc purchases of US goods, for example, buying Boeing jets or liquefied natural gas. While these peace offerings might help reduce some political pressure, it's clear Vietnam cannot simply buy its way out of opaque and erratic American trade policies. This brings us to the broader context. If you look at Vietnam's growing export figures, Vietnam has been gradually positioning itself as an alternative to China in many segments, offering cheaper labor and dynamic production capacity. In theory, this should protect Vietnam amid the global shuffle away from China-dominated supply chains, particularly with Western businesses looking to diversify manufacturing bases. But what happens when tariffs erode Vietnam's price advantage over both China and rival Southeast Asian production hubs like Malaysia and Indonesia? And let me tell you, don't believe the complacent rhetoric that rising US tariffs alone will be the extent of the problem. No, once domestic demand starts to contract, with dollar-denominated debt becoming harder to service due to a stronger greenback, Vietnamese businesses will begin to face tighter credit conditions. What comes next? Slowing growth, shrinking investment, and falling demand for exports. We have to give some credit to the State Bank of Vietnam, SBV, for maintaining controls on inflation and continuing stabilization measures. But the SBV now faces an unenviable decision: raise interest rates and risk choking off investment-led growth, or allow the dong to depreciate further and stoke higher imported inflation. The central bank has already adjusted the reference rates, but real monetary tightening would undoubtedly undermine growth, potentially squeezing household spending and business capital alike. But that's not all. Experts such as Citigroup's Helmy Arman suggest that continued dollar strength, courtesy of sticky US interest rates, represents additional headwinds for Vietnam. Despite the SBV managing to stave off a currency crisis for the time being, global markets are sensitive to sentiment. As trade war rhetoric heats up, skittish investors are likely to pull out short-term capital, sell off local stocks, or run up bond yields. What starts as a modest monetary headache could rapidly cascade into a broader economic fever. According to Michael Wan from MUFG Bank, any potential tariffs, high U.S. interest rates, and currency market volatility will likely act as triggers that accelerate these challenges. These signs, and the reactionary monetary policy in play, are symptomatic of broader issues facing many emerging markets. But what makes Vietnam's situation distinct is the combination of its export reliance, fragile currency conditions, and, critically, its overexposure to the U.S. market. That brings us to another commonly spun myth, that a weaker dong helps absolutely. Sure, it may make sense if you're looking purely at maximizing exports in the near term, but this is far from a zero-sum game. Remember when people thought China was getting ahead purely by managing its currency? It's no longer that simple. Vietnam finds itself in a similar predicament today. While boosting export-led growth sounds like a winning plan, eventually, tariffs wipe out the gains. Any further price cutting due to the dong's depreciation is a short-term fix for a long-term issue. Trade war implications, sector-specific hurdles, and tariffs create new market distortions. Plus, poorer currency valuations increase the cost of imported goods. Vietnam cannot decouple economically from global supply chains or food import costs. Inflation is less controllable, and inflationary pressures fall directly on individuals. So, are we really making progress? Vietnam's future scenario highlights the difficulties that emerging markets face as they grow deeper into the global system while remaining susceptible to external trade policy swings. Here's another reality check: global demand growth is slowing, across the board. The optimism that many nations had pinned on the so-called post-pandemic recovery phase has largely failed to materialize in 2024, and leisure spending remains sluggish. Vietnam's GDP growth rate, which averaged around 6 to 7% pre-pandemic, has already been downgraded to lower-for-longer assumptions for 2025 and beyond. The Vietnamese government has proposed some structural reforms, but the clock is ticking. Combined with falling new investment, notably FDI, slowing credit expansion, and risks in real estate and construction bubbles, the government is in a much tougher spot than it might be publicly willing to admit. The solution cannot be band-aid fixes like currency adjustments or symbolic U.S. imports. What's the escape route? For starters, Vietnam's apparent over-reliance on U.S. trade should spur diversification efforts. While the U.S. still represents a crucial trade partner, leaning more aggressively into Southeast Asian economic corridors and Southeast Asia's own Regional Comprehensive Economic Partnership (RCEP) agreements would provide greater balance. Meanwhile, a more formidable challenge faces Vietnam, effectively managing domestic debt and preparing for long-term adjustment among its industries. Vietnam still deals with structural domestic challenges, such as low worker productivity and clumsy regulatory frameworks, factors that aren't easily remedied overnight. Instead of scrambling to stabilize the dong, Vietnam should focus on debt restructuring, encouraging creative services industries, and instilling reforms to revitalize domestic markets, especially fostering high-tech supply chains where value addition is possible. Real investment reform is vital. So there we have it: a weakening dong, a looming tariff threat, and a whole set of long-ignored issues are coming up to the surface. As much as policymakers wish to paint a rosy picture of continued growth, sustainability is the name of the game, and sustaining an economy based on arbitrary dollar-denominated adjustments doesn't spell any success. Southeast Asia can no longer bet on weak currency policies to prop up growth. It's about resilience, about riding out both crises and opportunities in a sustainable manner. The Trump administration's tariff-happy policies are not a one-off hazard, they're an endemic risk of global trade amid rising geopolitical conflicts. And unless the Vietnamese government acknowledges the full scale of these risks, the dong may continue to weaken, inflation may spike unexpectedly, and Vietnam's economic resilience will be increasingly tested. Stay tuned, I'll keep monitoring what happens next in Vietnam's economy, but in the meantime, don't be fooled by the headlines. The deeper issues will always outlast the surface glimmers of temporary solutions.